JSPM's Rajashri Shaw College of Engineering, I invite Professor Gizla Makhija Madam for today's session on Reserve Bank of India Act 1949. Gizla Makhija Madam is our alumni student, and she is a topper in the batch 2014-16. She has experience of more than 10 years in the field of management. She has published various research papers as well as the books. Today, I would like to call Professor Gizla Makhija Madam to share her views on Reserve Bank of India Act 1949. Thank you, Gizla Madam, for accepting our invitation. Move to Gizla Makhija Madam. Over to Gizla Makhija. Please start.
Thank you so much, Meenakshi Ma'am. Such an overwhelming introduction. Good afternoon to one and all present here. Welcome all to yet another session of regulatory framework. Today we are going to take up RBI, in which we are going to study about its functions and the credit control measures which RBI takes. Now, India, as we know, has a diverse and dynamic financial system, and a well-functioning financial system is required for its economic growth and development. So what RBI does? RBI regulates and supervises the major portion of the financial system in India. Under RBI Act 1934, RBI, our central bank of the country, was established. It was established as a body corporate under the Reserve Bank of India Act in 1935. Now, RBI first, when it started as a shareholders bank with a paid up capital of 5 crores. And on its establishment, immediately it took over the functions of the government of India as for managing the currency, and also power of control from power of credit control from Imperial Bank of India. So it was nationalized in 1949, soon after country got independence. Now, Reserve Bank carries various operations and functions according to the provisions which are provided in Reserve Bank of India Act 1934. Now, basically, it's a regulator of money market in India, and as a central bank, it gives liquidity into the banking system whenever it is required. Now we come to features of Reserve Bank of India. It formulates, implements, and monitors the monetary policy through the various credit measures. It maintains public confidence in the system, protects depositors' interest, and provides cost-effective banking services to general public. It also maintains foreign exchange market through external trade and payments, and it also gives adequate quantity of supply of currency notes and coins, and of course they are of good quality. Now, therefore, the basic objective of establishing RBI under Reserve Bank of India Act 1934 was to manage the monetary and credit system of the country. It actually stabilizes the internal external value of rupee for balance and systematic development of banking and organized money market. This was established. It also provides finance to agriculture, industries, public debts, and maintains monetary relation with other countries of the world and also international financial institutions. It also helps in maintaining balance of demand and supply of currency. So these are the basic features. Now we come to functions of Reserve Bank of India, which are monetary functions and non-monetary functions. Under monetary functions, it is an issuer of banknotes. So it has the sole right to issue banknotes of all denominations except 1 rupee notes, which are issued only by Government of India. So it has a complete and uniform control over the currency and credit system of the country, and for that it has a separate issue department. It follows minimum reserve system for the issue of banknotes, and according to minimum reserve system, it has to have 115 crores worth of gold backing for the currency it issues. and rest 85 crores should be in the form of securities. So total sum of gold and the foreign exchange reserve, the minimum value of asset should be 200 crores. Now it acts as a banker to the government, as an apex monetary body. It acts as an agent of the central and state government. It provides them remittances, exchanges, loans, advances, other banking operations, and all are managed by RBI. Bankers Bank, it also acts as Bankers Bank in the sense that every bank is required under statutory obligation to keep minimum cash reserve with the RBI. And this enables RBI to provide further financial assistance to scheduled banks in times of emergency. Now, minimum cash reserve, which they have to maintain, is 5% of their demand liabilities and 2% of their time liabilities. It also exercises power of supervision and control over the banking system, like, for example, liquidity of assets of bank, management, their working. It also helps in amalgamation, reconstruction, liquidation of banks. All these are taken up by RBI. So basically, it acts as a banker's bank. It does all the things which are required to run commercial banks, to supervise them, to manage them, to regulate them. Now we come to lenders of last resort. Now, if a bank is in case of difficulty or in case of depression, periods of depressions are there when people want to keep the cash with themselves. In that case, banks feel the need for the cash. So they can borrow from the central bank, that is RBI. So how does RBI helps them? Helps commercial banks by granting loans and through buying their securities. So central bank assumes the responsibility directly or indirectly in providing funds to the commercial banks in times of difficulties and crisis. Further custodian of foreign exchange reserves. So Reserve Bank is also entrusted with the responsibility of maintaining the external value of rupee, and for this purpose, it holds various foreign exchange reserves. So basic parameter of maintaining the foreign exchange reserve is safety, liquidity, and returns. So it is, as India is also a member of IMF, so Reserve Bank has to maintain the fixed exchange rate with all the member countries of the fund. Then as a controller of credit, it through maybe bank rate or changing the bank rates, or through market operations or selective control of credits, RBI also exercises control of credit through commercial banks. It also provides license to the banks for expansion purpose. Suppose they want to expand their branch, so they need permission from RBI. The RBI may ask for weekly returns also for details related to its assets and liabilities. So it has the power to call for such information and also has the power to inspect the accounts of various commercial banks. So these were the monetary functions of RBI. Now we move to non-monetary functions, which are supervisory functions and promotional functions. So supervisory functions are to promote and develop the sound and efficient system of banking in India. RBI supervises the various different banking financial institutions in India, and how it supervises. It provides license, branch expansion, liquidity of assets, management, looking after the management, working, and amalgamation, reconstruction, and all these. So let us take one by one all these functions. First one is providing the license. So anybody who is wishing to commence banking business in India is required to obtain license from RBI. And then coverage of banking operations for the proper conduct and organization of banking system in India. The Regulation Act prescribes the minimum paid up capital, reserves, and cash reserves, liquid assets, which has to be maintained by every commercial banks. depending upon the geographical coverage of the bank's operation. So all these requirements have to be fulfilled by any bank who is under the regulation, Banking Act regulation. Now, liquidity of the weak banks. To strengthen the commercial system and the structure of the financial system in India, the RBI is empowered to compulsory liquidate all the weak banks which are not doing good business, or it may instruct for the merger with the stronger ones. It is also empowered to inspect, inquire, and take necessary action to improve the operational efficiency of the bank. So this is all is about liquidation of weak banks. And then for any branch expansion, also any bank has to take permission from RBI, whether it has to open the branch in particular area like small towns or rural areas. To improve the geographical coverage, so RBI decides where to open the branch. Then to improve the functional coverage of banks, and for the proper sectorial distribution of bank credit, it also favors the priority sectors for giving away credit like agriculture, small scale industries, self-employed persons. So RBI can issue directions to commercial banks to which sector it should provide credit. Then training of bank personnel is also undertaken by RBI, which includes setting up many training institutes in the country. The principal institute is Bankers Training College in Mumbai. And then we have National Institute of Bank Management also, and Cooperative Bankers Training College, Pune, etc. All these colleges are for education and training of different categories of bank personnels. Now, also RBI is empowered to restrain, control exercised by different groups of persons or people over the affairs of the bank. So it may direct any particular bank to either for the advancement of the loan or for giving the guarantees for the particular company. So it may also endorse a particular appointment or removal of the bank's executive personnel. So all these powers are also there with RBI. Then we have RBI is also empowered to collect and also supply the information regarding the credit facilities by banks and other financial institutions. Then to spread the banking habits, the RBI instills public confidence through Deposit Insurance Corporation in 1962, which was established as a subsidiary of RBI. It gives insurance of rupees 1 lakh per individual from DICGC in case the banks fails. So this is all to inspire greater public confidence and spreading the banking habits among especially the lower section of the society. Now we come to promotional functions. In promotional functions, it also acts as a promotional agency and work for the development of the banking system in India as compared to merely acting as a monetary authority. Because as we know that in the year 1935, around independence, our country lacked well-developed money market and commercial system. So to establish a more efficient and sound banking system in our country, Reserve Bank of India was established to pursue appropriate and proper credit policy and take necessary steps for the fast growth and development of all the sectors of the economy. And it therefore is called a central bank of our country. So various promotional steps which are taken by RBI One is establishment of the bill market scheme. It was established in 1952. Then various specialized financial institutions like Industrial Finance Corporation of India, State Finance Corporation, Industrial Development Bank of India, Deposit Insurance and Credit Guarantee Corporation of India, NABARD, all these institutions were established as a wholly owned subsidiary of RBI. Then we have regional rural banks, which were established to extend banking facilities, especially in the rural areas. Then we have National Housing Bank, which was established again to organize and augment resources for housing. It also provides full support to the industries which also supplying the materials for the construction. It also established Export-Import Bank of India to provide finance to the exporters. So it also helps commercial banks in opening branches in foreign countries for helping the foreign trade of the country. Then it promotes and encourages research in the area of banking. So these are the functions of RBI, monetary and non-monetary. Now we come to credit control measures. That is the technique of monetary policy, which is pursued by RBI. So as a regulatory role of RBI, it formulates various monetary policies to speed up the economic development and growth of our country. It is undertaken various measures it takes to regulate the supply of money, the cost, the direction, and the availability of credit in the economy. RBI uses various credit measures as a weapon to basically control the cost of credit, the amount of credit, the purpose for which the credit is being given. So for that, it has various techniques. We have quantitative techniques and the qualitative techniques. For regulating the cost and the amount of credit, we have quantitative, that is volume. It regulates the volume. And for various selective control measures, we have qualitative, that is, it provides the direction. Now, under quantitative, that is, we are managing the cost and the amount of credit which should be regulated. So for that, we have various methods like bank rate. Now, what is bank rate? Bank rate is also known as discount rate. It is the rate at which the RBI discounts the eligible bills. So it also refers to the minimum rate at which the central bank provides financial accommodation to the commercial banks as for discharging its function as a lender of the last resort. Currently, the bank rate is 4.25%. Then we come to open market operations. So it also undertakes various operations in the market like purchase and sale of foreign exchange, gold, government securities, and even company shares. So under open market operations, central bank seeks to influence the increase and decrease of the supply of money in the economy. So it actually, through commercial banks, it can regulate the supply of money in the economy. It can expand also, it can contract also. Then comes variation in the reserve requirements. There are two types of reserve. We have cash reserve ratio and the statutory liquidity ratio. So by changing these ratio, it can influence the credit creation power which the commercial banks have. Now, cash reserve ratio is refers to that portion of the total deposit of a commercial bank which it has to keep with the RBI in the form of cash reserves. So at present it is 3%, 3%, and it has to be maintained fortnightly on average basis. Statutory liquidity reserve, currently it is 18.50%, and it is that portion of total deposit of commercial banks which it has to keep with itself in the form of liquid assets. So there are two types of reserve. We have studied cash reserve ratio and statutory liquidity ratio. Cash reserve ratio is to be kept with RBI, and statutory liquidity ratio has to be kept with the bank itself in the form of liquid assets. Now, it is fixed as a percentage of entire demand and time liabilities, and liquid assets can be like gold, cash, or approved securities. So by altering or raising these two ratios, the Reserve Bank has a control over the lending capacity of the commercial banks. Naturally, the higher the ratio, it will force the commercial banks to maintain a larger portion of resources in the liquid form, and then it will contract its capacity to further give loans. Now we come to repo rate and reverse repo rate. These rates are actually related to RBI borrowings. Whenever the banks have shortage of funds, they borrow from RBI, and RBI lends to the banks at the repo rates. So basically, repo rate is the rate at which banks borrows rupees from RBI, and reverse repo rate is the rate at which Reserve Bank borrows money from banks. So either way we can use it. The RBI uses it to transfer the funds to the commercial banks, or transfer funds from the commercial banks to the RBI to contract or expand the monetary aspects in the economy. Then we have liquidity adjustment facility. It also allows the bank to borrow money through repurchase agreement. It started in 2000. In the year 2000, it was instituted to manage day-to-day liquidity in the banking system. Further, we have market stabilization scheme. It was introduced in 2004, specifically to manage the excess liquidity which was arising out of the huge capital inflow into India from abroad. So basically, it was established, or you can say introduced, to sterilize the impact of the foreign capital inflow, which was quite in number in the year 2004. Now we have selective qualitative, which you can say selective qualitative methods. Basically, they are designed to divert the resources for the particular or specific purpose. So it is designed to also regulate the direction of credit, basically by distinguishing between the essential and non-essential use of bank credit. Now, first of all, in this, we have rationing of credit, in which we control the purpose for which the bank credit is given. So it is also exercised by RBI. Under this, we restrict the demand for accommodation and rediscounting facilities for each bank. So basically, it will curtail the freedom and the initiative of the commercial bank. And then we have margin requirement. That is the difference between the value of security and the amount which is borrowed against the security. So RBI is generally empowered to fix the margin limit for which, for various uses for which the credit is being given for commercial banks. So it can set the margin if the margin is high. So naturally, the loans and advances will be contracted. It will affect the lending ability of a commercial bank. So margin requirements, while directly affecting the lenders, it also put the restraint upon the borrower also. And that's why it will affect the volume of the credit. Then we have variable interest rates. So by charging selectively for different uses, places, and borrowers, we can again contract or expand the money supply in the economy. Now we come to regulation of consumer credit. Under this, there is a practice that of when we have abundance or shortage of the consumer articles, we can have a regulation which includes permitting or banning the credit for the purchase of certain consumer articles, and or extending or limiting the time for the repayment, or lowering or raising the limit of down selective methods, what we are doing is we are recognizing the important purposes for which the credit can be given. And the last two are moral persuasion and publicity, for which the central bank also can ask for cooperation from the commercial banks. It can orient them about the various monetary policies and persuade commercial banks not to provide for credit for non-essential or speculative purposes. So in this way, the RBI can educate the banks regarding the economic system of the country and may guide them where to give the credit and where not to give the credit, and what are the requirements of the economy, and to work accordingly. So basically, moral persuasion involves the psychological means of controlling the credit. Then we come to publicity. So it's the last technique which is taken up as a qualitative measure by RBI. In this, it provides large-scale publicity to the good economic policies for the commercial banks to follow, and also what are the harmful policies which will actually affect the sound and efficient functioning of the credit system. So it provides, naturally it will provide again moral pressure on the banking business, and through publication of the various economic and financial statistics, it can also help the banks to take necessary steps to improve their economic conditions, and also for the economy in general. So this is it for today's session. We have done complete RBI with its function and credit control measures. Thank you, everyone. Hope you have understood. Over to
Thank you,
Meenakshi
Gizla
Madam.
Madam, for taking a very wonderful session. Thank you very much. And I think part 2 you will complete in the next session, right?
Yes. Yes.
There are the participants. Mrutyunjay, do you have any queries regarding this? You may clear your doubts if you have. Hello, Mrutyunjay. Please speak something.
No, ma'am, no doubts.
Okay, fine. Very good. Very good. So, Gizla Madam, thank you very much for sparing your valuable time. Thank you. And we would like to invite you in your future time period also. Thank you, Madam. Thank you.
Thank you so much, Meenakshi ma'am. Thank you.